I think on average that the way that the market values companies is by a concept called mean reversion. Strange enough, there was an article about it on the back of the Financial Times fund management supplement this morning by a man called Edward Chancellor from a fund management company called GMO. And mean reversion means this: if a company's got very high margins and very high returns on capital, it will attract competition. People will enter the industry, competitors will expand, the company itself will employ more capital as well. And gradually those returns will be driven down towards the average for the market. And if a company's got very poor returns on capital and very poor margins, capital will exit that strategy. Basically, companies will exit because they can't make an adequate return, companies will go bust, nobody will invest in new capital, and gradually the returns within that company and that industry will start to gravitate up towards the mean. And I think it's a very, very good theory. And I think as a way of valuing companies on average, I salute it. I think it's the sort of thing that people should apply. I think that the reason that this strategy or one of the reasons why this strategy may be viable, is viable and may continue to be viable, is I think there are a small group of companies in the world that don't mean revert, that have superior margins and superior returns that don't get competed away. And that's because they have huge intangible advantages. They have brand names, patents, intellectual property, distribution networks, installed bases of equipment to which they have a tame market for selling spares and service, or all of the above. And as a result, they're able to fend off competition so that the capital can't enter their markets readily to mean revert. And those are the companies that we seek to own. So I think there's an economic reason for us being able to buy these companies somewhat cheaply. I think there's also a behavioural reason, and that is, I think, as investors, as human beings, we're attracted to excitement, basically. If you look at investors, they seem to believe, and there's quite a lot of economic theory to support this, that in order to make a superior return, they have to take a higher risk. We're taught that. There's economic theory behind it, the efficient markets hypothesis. There's plenty of folklore behind it. There's no such thing as a free lunch. You know, if you want to make more money, you have to take higher risk. Unfortunately, for about the last 50 years, all the statistics tell you the opposite. You make most money from the most stable and least volatile shares. But still people persist in buying the small companies and the very volatile shares, thinking that by assuming that risk, they're going to make more money. There's no sign of that whatsoever. But I think we are innately attracted to it. I think the best way of describing why we do it is the so-called lottery ticket effect. You know, if you buy a lottery ticket, you are definitely not basically someone who's done it on the application of statistics, because you're overpaying for the odds of the very large win. But it's the very large win that attracts you. And that's why I think we are attracted towards these very apparently high return risky companies. And that's what gives us our opportunity, I think, to buy our very good, relatively predictable companies at a relatively cheap price. So, yeah, I often get asked about valuation. Probably the most amusing questions I get about valuation are from a couple of people that I encounter who we talked to at the outset of Fundsmith, or even before we set it up, who said a couple of things which always amuse me. One of them being, well, I mean, your timing's really poor at the moment. I mean, the economic outlook is bleak. You yourself are very bearish about it, etc., etc. You know, have a look at it another time. Some of the same people say to me, well, it's only succeeded because of the good timing. I mean, if you hadn't started it then... I sometimes wonder if they ever sort of remember the things they previously said to you. And the other one I particularly like is the people who said, look, I really like the strategy and what you're doing, but I do think that this is a bad time at the moment, and I think, you know, when there's been a significant decline in the market, I'll buy some. I often think we're up about 50% today from